It is very premature to be thinking about pausing. We have a ways to go. Our policy, we need ongoing rate hikes.
Hi guys, it's Stock Curry, and the stock market's absolutely crashed on Wednesday after Jerome Powell spoke post-Fed meeting. In today's video, I'll explain exactly what Jerome Powell said to crash the markets and where the market's going to go from here. So let's get into it. The Federal Reserve raised interest rates by 0.75 points or 75 basis points on Wednesday, and initially this sent the stock market skyrocketing. A 0.75% rate increase is exactly what the markets were expecting. So when Jerome Powell did that and didn't come in and do something, say, higher, the stock market rose. Now, there was another thing that caused the stock market to rise almost 1% after the decision came out. And that was a change to the statement that goes along with these rate increases at every meeting. The key change, and there was only one, to the Fed statement caused people to think that the Fed might slow down or pivot. Keep in mind, the entire reason the market was rallying over the past week was because people thought the Fed might pivot, and the statement that came out with the rate hike seemed to point to that possibly being the case. Aside from the increase in the Fed funds rate, the statement change was as follows. The committee anticipates that ongoing increases in the target range will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the legs with which monetary policy affects economic activity and inflation, and economic and financial developments. This seemed to point to the fact that the Federal Reserve understands that monetary policy changes take time to affect the economy, and that they possibly may have done enough increases at this point that they might slow down or stop rate increases and give the rate increases that they've done so far time to work their way through the economy. And this is why we saw the stock market rally after this statement came out. But then we saw the stock market turn around and absolutely tank. And that is because of what Jerome Powell said when he started speaking.
Today, the FOMC raised our policy interest rate by 75 basis points, and we continue to anticipate that ongoing increases will be appropriate.
So right off the bat, when Jerome Powell started speaking, he said ongoing rate increases will be appropriate. And this seemed to counter people's hopes that the market would pause the rate increases.
In addition, we're continuing the process of significantly reducing the size of our balance sheet.
Jerome Powell followed that up by saying that they will continue to do quantitative tightening, which will cause mortgage rates and treasury yields to continue to rise as well.
We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. That's why we say in our statement that in determining the pace of future increases in the target range, we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation.
Now, at this point in Jerome Powell's speech, people started to get a little bit of hope once again, because he reiterated what was stated in that statement. And it caused people to think, well, okay, even though future rate hikes might be necessary, it looks like they're probably going to slow down. And the market started to breathe a little bit of sigh of relief, started to go back up again, until Jerome Powell continued his speech.
The incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
When Jerome Powell said that, this is when the market started to crash, because there was this belief that the Fed would do a 75 basis point rate hike at this meeting, which they did, and a belief that they would do a 50 basis point rate hike in December. and that cumulatively that would be the end of the rate hikes. That would get them to the rate that they said they wanted to get to in September. But once Jerome Powell said this, that at that point, it now looks like the Fed is going to raise interest rates even higher than what they had said in September. And that really caused the market to start to crash.
Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting.
As Jerome Powell continued to talk about the interest rates being higher than what they stated in September, the market continued to crash. But then Jerome Powell said something that gave the market a little bit of hope and paused that market sell-off briefly as Jerome Powell said this.
With the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that.
When Jerome Powell said that they would start slowing down the rate of rate increases at either their December or January meeting, the market started to rally once again. And that is because this seemed to indicate the quote-unquote Fed pivot that the market was hoping for. Unfortunately, that rally would be short-lived.
We still think there's a need for ongoing rate increases, and we have some ground left to cover here.
Jerome Powell reiterated that ongoing rate increases would continue. Now, at this point, people were a little confused. At one side, he's saying that we need to keep raising rates, and on the other hand, he's saying that they can slow down the rate of rate increases. So at this point, the press started to get straight to the issue and started asking Jerome Powell as clearly as possible, what are you actually going to do in the future? Are we going to see rates stop, or are we going to see rates continue? What's going to happen? And so then Jerome Powell started addressing the reporters' concerns, and that's when we saw the stock market really start to tank.
This is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. We'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
In yesterday's video, I talked about how in order to get inflation down, the federal funds rate would have to be above the rate of inflation. With the current PCE or core CPI inflation rate running at around 6%, the federal funds rate would have to be above 6% in order to cause a restrictive policy and get inflation down. Now, what Jerome Powell is saying here is that even though the classic Tabor rules would point to the interest rate having to be above the rate of inflation in order to get inflation down, Jerome Powell thinks that the rate that consumers and businesses actually borrow at is, so long as that rate is above the rate of inflation, that would be sufficient in order to get inflation down. So you can look at mortgages, for example. The current mortgage rate is well above 7%. Now, even though the Fed funds rate is only at 4%, the mortgage rates are well above 7%. And what Jerome Powell is saying here is that with the current rate of inflation being at 6%, even though the Fed funds rate is only at 4%, the fact that consumers are borrowing at 7%, that the rate of borrowing is higher than the rate of inflation. So at this point, we have a restrictive policy. So essentially, Jerome Powell is saying, I'm not really concerned about Tabor rules right now. I'm looking more at the actual rate that people are borrowing at, and the fact that that is higher than inflation. Jerome Powell feels like we are currently at a restrictive policy since consumers and businesses are borrowing at a rate that's higher than the rate of inflation.
Is inflation becoming entrenched? Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. Once you see it, you're in trouble.
Now, this statement was really interesting because this was the very first time that I have heard Jerome Powell say that he is concerned about a wage price spiral. Jerome Powell did make it clear that we do not have a wage price spiral right now, but he did make it clear that the recent estimates of inflation rising could point to a wage price spiral occurring in the future. Essentially, what Jerome Powell is saying is that if expectations are that inflation will become entrenched, then businesses might raise wages in order to attract employees. And if businesses increase wages in order to attract employees, that could cause the wages to go up, which in turn would cause people to have more buying power. That in turn would cause inflation to go up. That in turn would cause wages to go up, which would cause inflation to go up, which would cause wages to go up, which would cause inflation to go up. And this is known as a wage price spiral. And Jerome Powell, for the first time, has said he's now concerned that that might happen. And because of those concerns, he's looking at it. It's not happening yet, but he is concerned that that could happen. And if it does, then inflation could become entrenched. And at that point, we start getting into a hyperinflation period. And at that point, the Federal Reserve would essentially have lost control. So Jerome Powell's very concerned about this, and he's going to continue to raise interest rates at a very aggressive pace in order to get inflation under control. And the simple fact that Jerome Powell is very concerned about this is very concerning to the stock market and the economy overall. And that's why we saw the stock market continue to sell off as Jerome Powell said this.
If we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking.
Now, this was another thing Jerome Powell said that caused the markets to continue to sell off and get to that point where they just started crashing. And that was the point that Jerome Powell said it is far better to over-tighten, that is, to raise interest rates too much, because if they do over-tighten, they do raise interest rates too much, and we do end up in a recession, then the Fed has the ability to re-stimulate the economy just like they did in April of 2020. However, if they don't raise interest rates enough, then that means they may never be able to get a handle on inflation, and inflation could get out of control. So this, in summary, just says that Jerome Powell is saying the Fed is going to be more hawkish rather than dovish, and the Fed is definitely going to want to raise interest rates more rather than less. So this, at that point, the market really started to sell off. It started to get to that point where it was starting to crash. And then Jerome Powell just finished it off and basically just stuck the nail in the coffin with what he said next.
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive.
This pretty much dashed all hopes that the Fed would pivot. The market rallied last week in hopes that the Fed would pivot, and Jerome Powell just completely shot that down and said, no, it is way too premature to be talking about stopping the rate of rate increases or stopping raising rates at all. And the market was like, oh crap, all hope that the Fed might pivot is gone. Jerome Powell is very clear that they will continue to raise interest rates. And just in case you didn't get it, Jerome Powell reiterated that statement.
It's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go.
So there you have it. Jerome Powell was very clear that all of this hopium based upon these false speculation that the Fed would pivot is completely and totally wrong. And Jerome Powell is very, very strictly saying we will continue to raise interest rates to get inflation down, even if it means causing a recession, even if it means that we have to raise interest rates too much, we will do so in order to get inflation down. And that is why the market crashed. All hope of a Fed pivot is gone. All hope of the Fed slowing down rates significantly is gone. While Jerome Powell did say they might slow down the rate of rate increases to say maybe a 0.5% rate increase in December or January, at this point, any thoughts of stopping rate increases is just completely off the table. And at this point, it does look like the stock market will continue to fall. Taking a look at the technicals, the S&P closed below the 21-day EMA today, which is very, very bearish. And the NASDAQ closed below the June lows, which is very, very bearish. All signs point to the stock market continuing to fall in the short term. The one hope I would say is that the stock market does typically rally after the midterm elections. Those midterm elections occur on Tuesday of next week. So there is still hope that the stock market might rally starting on Wednesday of next week. But for now, through Tuesday, it does look like the stock market will continue to fall and will continue to crash. And with all of the market volatility today, I was able to make over $2,000 trading. As you can see, we're up 26% on this Apple put. We're up 27% on this SPY or S&P 500 put. We're up 24% on this QQQ or NASDAQ put. And we're up 31% on this Amazon put. And I know you guys have been waiting for a long time to start making money with me in our coaching program. After 2 months of being closed, I am very, very happy to announce that the coaching program has been reopened and I am now taking new signups. Just go to weprofitdayandnight.com and you can schedule a call with an onboarding specialist who will get you into the program. I do want to let you know that the first 20 people to sign up are going to get a 20% discount. That is just my way of saying thank you for being patient over the past 2 months and waiting for this program to get reopened again. So again, that's weprofitdayandnight.com to schedule a call with an onboarding specialist who will get you into the program. And again, the first 20 people to sign up are going to get a 20% discount. I hope you enjoyed this video. If you got a lot out of it, be a good friend and share this video with your friends and family so that they will know why the stock market is going down and what to expect in the future. And click the like button and subscribe. And if you want to know more about why the stock market is going down, make sure you go watch the last video that I uploaded here.